We basically go around the world to all the gambling conferences and just basically speed date with young, savvy entrepreneurs that are building differentiated tech in the gambling space. We've been able to compound at 100% per annum for 5 years and hopefully our investors think we've done a good job for them. So if they'd rather like die than let this business fail, that's amazing. We see some founders that are ultra slow, like getting back to email, replying, getting on calls, late to calls, or like they can't even get their own stuff together, let alone the company. But then you come across people that are just literally will go to the end of the earth to make this thing work. And we love that type of person because they are all in and will do anything possible to make it work in some way. I'm not some TV expert. I actually head of Channel 9 Sport when I went in for the dry run. He goes, I've never seen anyone with less talent in my whole time on television ever. So that was very intimidating and scary to be on live TV to like 1 million or 2 million people. And I remember I was on Dancing with the Stars, it'd be 20 years ago now, and I would have gone to the toilet 20 times or 30 times before going on, just because it's so scary.
Tom, thanks so much for joining us. It's a real pleasure to have you on, and I look forward to what we're going to get into.
Thanks, Tom. Good to be on with you guys.
What we like to do is kick off just a little bit with the origin story. I think a lot of people would know some things, but they might not know is that you're a VC investor now. So how did you make your way into VC, and what's those origin steps?
Yeah, okay. Yeah, look, we've been running Waterhouse VC for the last 5 years, and the background is my family's been in the betting or gambling industry for over 100 years. So my great-grandfather was a bookmaker in the 1800s. My grandfather was a bookie. My dad was a bookie, run a professional betting syndicate for 44 years. And straight out of uni, I was a bookie at the dogs and at the horses. And it was a really fun and lucrative business. I basically had a blueprint of how to do it from my grandfather and my dad. So I was very lucky to basically have those two as my mentors. And my dad had a professional form system. So I had a huge leg up and thought that I would be a bookie for forever. But what happened in 2007, 2008, 3G, internet, iPhone, and advertising restrictions got lifted here in Australia. And I went from being actually the biggest bookie in Australia, turning over sort of $300 million a year as an on-course bookie, to a business that was struggling to get much turnover at all. And so knew I had to go online, launched tomwaterhouse.com in 2010, and went from 100 customers to 250,000 within 18 months, but just didn't have the scale to compete with William Hill, Ladbrokes, Bet365, Paddy Power, and so on, who came into Australia. And William Hill did a $700 million roll-up in 2013, and we were a small add-on as part of the 3 businesses they acquired. But they asked me to be CEO of that company. So I was CEO of that company for 4 years. We had 500 staff, 2.5 billion in turnover, over 1 million clients. So it was a reasonable sized business and a great experience to run that for them for 4 years. I had offices in the Philippines, in Tel Aviv, New Zealand, Australia, and so on. But that business sold to PokerStars as part of the BetEasy PokerStars Flutter roll-up in 2018. And I had a 2-year non-compete. And I really thought, well, where is the edge? Where's the value in the industry? I can't be a bookie. And the edge, because of advertising restrictions and regulation, had gone from being the operators to the suppliers to the operators. All the suppliers take a percentage of the gross gaming revenue, and they're much harder to understand. It's much easier to understand the value of a Tabcorp or a Caesars or an MGM because it's the same lines in the P&L. But understanding what betting engine Sportsbet use, or what mobile app development team they use, or what data feed they use for rugby league or English Premier League or racing, is you have to have a really good understanding of the industry and the suppliers and the players within that industry. And so that was the beginnings of Waterhouse VC back in 2019, 5 years ago.
And it's been a pretty phenomenal ride since, like in 5 years. And I know it's 5 years this month, but your returns, you've had a gross total return of over 3,000%, 100% annualized.
Yeah, we've had great return, but the reason being is what we realized. So I asked a handful of the best developers. We had 170 developers in Sydney, another 100 in the Philippines. And I said to them, look, the business being sold, rather than going to find another job somewhere else, come with me, let's go and analyze the best tech around the world. And we found a data supplier for racing, and we put some money into that business and was able to acquire an option in that business to buy 19.9% of the company. And the company went from 18 cents a share to $1.50. And I went, gosh, this option stuff, I hadn't looked at options since I did commerce at uni, didn't really have any understanding at all, but realized that actually this option strategy is a good one because the first deal came off, and also interest rates went up over that period as well. So a lot of these suppliers couldn't get funded like they could in 2020, 2021. And we went in and have optioned up, many tech suppliers to the gambling space. So we're in a voice betting solution, esports data supplier, racing data supplier, platform businesses, and we buy options in them at an agree a strike price at around today's value. And if they can grow and get many contracts and get global distribution, they suddenly become very valuable. And so we have, we've been able to compound at 100% per annum for 5 years, and done hopefully our investors think we've done a good job for them. But yeah, and I love doing it. We basically go around the world to all the gambling conferences and just basically speed date with young, savvy entrepreneurs that are building differentiated tech in the gambling space. And that's what we do.
I think Jack's pretty keen to chat about the options and how you structure things, but maybe just contextually for listeners, it sounds very much like you're investing in the picks and shovels of the industry, like the underlying technology on the supply side rather than the operational wagering side. Is that right?
Yeah, correct. So I'll give you an example. Like, we know in America, they love betting on basketball or NFL or baseball, but it's a limited season, and they haven't got racing like we have in Australia that's wall to wall. And only 8 states have got iGaming approved. So in all these states that have online sports betting, there's a big product gap. So we go, well, look, there's a product gap. They can't put iGaming or slots machines and pokies and roulette in. So what's going to fill the product? We thought, well, maybe racing will. So we've done option deals with racing providers. We just announced an option deal this week with a listed racing supplier called Racing and Sports, which we believe have a very unique data set and a very interesting business. But we thought, well, what else can fill the product gap? And so we thought maybe esports could fill the gap. We're not experts in esports. We just thought, well, maybe that's something that operators in the US would be interested in. So we did a deep dive on that area. We went and spoke to many of the providers. We then narrowed down what we thought were the best handful. We then spoke to the people that they have contracts with, and then said, well, look, what are their service level agreements? What's their uptime? How are they to deal with? How responsive are they? Then we narrowed it down to what we thought was the best firm. We went and visited them they were in Prague, went and looked at their models, spoke to their tech team, understand why they've got an edge or have they got an edge. Then spoke to the esports leagues. Have they got proprietary? Have they got the ability to get your data and got some exclusivity agreement? How long, how robust is that? And then when we get a real good understanding and go, well, we think this is the best supplier or a top tier supplier that could get much broader distribution than just in Eastern Europe, then we go, okay, well, how do we go about acquiring an option in that business? And maybe it goes nowhere, and we've obviously it's cost us the value of the option, but if they can go and get distribution in the US or Brazil's just opened up, or in Australia or UK, it's obviously then very valuable option.
We touched on the evolution of the gambling space, going from brick and mortar to online. Would love to hear your thoughts where you think the value is going to be captured going forward, both on the operator side and on the supply side.
Yeah, okay. You just couldn't fathom sort of 20 years ago that land-based operators like a Coral or Ladbrokes or William Hill, they were the global giants in the UK. And then Denise Coates and the family built Bet365 into a global giant, and really they used their online tech, built the platform, and Bet365 changed the game 20 years ago. What we're seeing now is that businesses like Stake, sportsbet.io, they're using different payment methods, whether it's with crypto and different user experience and different ways to market through influencer marketing and affiliate marketing that traditional operators, when I say traditional operators, the operators that have dominated the last 20 years, have not been using. And so you've seen like those two businesses become some of the biggest gambling firms in the world. And what's amazing about them is they're actually both those businesses are headed up by Australians, very savvy Australian entrepreneurs. And so I think what you've seen is that people have found with advertising and regulatory environment getting tougher, you've seen people differentiate and pivot to a way that makes it is not traditional way of normal payments and in normal like regulatory setup. And they've also differentiated on customer experience. And that's probably the biggest difference, especially in the regulated markets, because you can't spend the same way as you used to, $100 million on TV advertising or $300 million on TV advertising anymore. It hasn't got the same cut through as it did 10 years ago. So basically how they're trying to differentiate is in the products to try and get higher value to a customer, less churn, network effects of people betting with each other, like Bet with Mates products. So it's really about the customer experience and the products because they can't do the same advertising as they were doing previously.
I read your monthly update that you release on LinkedIn, and that's where I became aware of Shuffle, another Aussie company, and like just the growth that they are experiencing. It is just unbelievable, and it's actually hard to believe like how fast they are growing. It's such an interesting sector.
Yes, yeah, it is amazing. Again, another incredible that Australia has led the way, and maybe because it's the largest gambling per capita in the world, but really led the way in terms of bookmaking, professional betting, and now with these crypto operators. And it just is really about people that can differentiate the customer experience and also ease of use, and thinking about how to adapt that and how to adapt in a regulatory environment that allows you to do that. It's such a double-edged sword for the regulators, because on one hand, you can completely understand why they want to restrict advertising, they want to put extra restrictions and taxation, but also on the other side of the sword, or the other side of the equation, is for people that love to bet, they just want to be able to do it in an easy way that's easy and as frictionless as possible. And what's hard in the US is that obviously you've got to fill out significant forms. If you win over $600 US, the account sign-up process takes a long time. Traditional banking methods, you're taking days to get paid. You sign up forms, know your customer requirements. In the UK, they've got like a lot of stuff that you've got to do if you bet or win over £2,000. It's a really changed environment, and it's not to say that the regulators are wrong in that, because there's very good reasons why they are putting those things in. But for the regular bettor that likes that as entertainment, they are going, well, actually, there's a very easy alternative, and the user experience is fantastic. The payments great, and once you get a sticky customer and you get more revenue, well, then you've got that flywheel effect that you can put that extra revenue into improving the customer experience, which improves the retention, the value of the player, and then it goes on and on. You can spend more on marketing and so on. So really, you've seen these people that have looked at the market differently, and they've found a way to change the experience. Similar to Bet365, what they did 20 years ago. They changed the experience and have dominated for a long period of time. And I'm sure they will dominate for a long time to come. But there's several new operators that are changing the game now.
There seems to be a lot more betting and wagering occurring in the metaverse, for want of a better word, where I think a lot of the older generation are used to betting on real, physical, live things. But there seems to be huge volumes now in the wagering space that's moved into this digital world. Is breaking that up into those two categories a reasonable thing to do, or actually is it all just one and the same?
No, it's very blurred, or at least I find it very blurred, because I look at my 8-year-old son playing video games, and the mechanisms that a lot of these video games with the loot boxes and getting you to pay more to get extra levels or to get extra like gems or tools or clothing, it's very similar mechanisms across gambling to video gaming, and what is the balance and what you should be doing, and it's blurred in many respects. And you look at the like buttons on social media, they're giving you that like dopamine hit, which is similar to you get a dopamine hit in types of gambling. So I'm not saying they're one and the same. I'm just saying that the mechanics across them are similar. So drawing the line of saying this is a particular type of gambling, or this is gaming, or this is video gaming, they are distinct, but they're also blurred in some ways. And so For us, we don't invest in companies that take bets. So we have no investments in businesses that take bets from customers, but we invest in the suppliers. And really where we focus on the suppliers is in the area that we understand really well, which is the online wagering. So sports betting and racing. It doesn't mean we don't look at casino products or gaming products, but it's not really in our wheelhouse. Again, like I see my son playing, but I don't really understand the mechanics and the dynamics of a video game business that comes and pitches to us as a supplier, or a gaming business the same way as I'd understand a racing product or a betting product, a sports betting product, because I lived and breathed that part of the industry for 20 years. In terms of what's interesting is how dominant online gaming is, or gaming is, to sports betting and racing. So we're in a niche part of, because we're in gambling, like it's a niche industry, but we're actually in a niche part of the gambling industry, because in Australia, for instance, the gambling loss, only 15% of that gambling loss is made up of horse racing and sports. 85% is made up of lottery, casino, pokey, casino products. And that's not our area of expertise. I've never run a land-based casino, and obviously I understand the online dynamics of a casino, but not in the same way as sports betting and racing. But what's really interesting is the shift through COVID is that there were so many of those land-based bettors that used to go into a tab outlet to place their sports bet, or go into an RSL or a casino to place their their land-based casino bet or pokey bet. But COVID really accelerated that shift to online. And what's interesting about Australia and much of America, unlike the UK, is you're not allowed to bet online for any gaming products. And that's a huge opportunity for the racing industry. But it's also something that the regulators need to keep their mind on in terms of the US and Australia, in terms of leakage of people finding ways to bet with unregulated players to have their online bets for casino games.
You mentioned a word before that we spend a lot of time on our portfolio with: niche. And also from one of your updates, I read you put, as highlighted in our June 24 newsletter, emerging wagering businesses have the greatest chance of success if they focus on dominating a niche without a clear market leader. Focus and niche are just words that we constantly repeat. Like, where do you find entrepreneurs going wrong there? Why do they find that so hard? And how do you go about, I guess, influencing and mentoring your portfolio on focus and niche?
Well, I think about it. So a good example in the industry here is that US opened up in 2018. One online operator's had 1 quarter of profitability since 2018, so in 6 years. And everyone charged and said, we're going to be that operator in the US. It's a gold rush. And that's great. One or few operators will make probably a lot of money in the US, but it's highly taxed, highly regulated. Scale is very, very important. So you're seeing a huge dropout of operators in the US, and basically people are rushing in going, oh, largest economy in the world's opened up online gambling, online sports betting, let's charge in. And they were probably fast followers, but they were doing the same thing as everyone else, and most of them are subscale, where there's been a few operators that go, well, actually that market's really exciting. What is nobody doing, and what is there like an opportunity? And so you've seen some affiliate businesses, you've seen some sort of free-to-play games businesses take off and make a lot of money in the US. There's a business out of Australia that we actually got the opportunity to invest in, because it was very early, but it was business B2C rather than B2B, and we didn't invest, but run by a very savvy group of young Australians called Dabble. They entered a very mature Australian market, but they differentiated by having this betting and social functionality of betting with your mates. And they've done very well. They've sold a chunk of that business to Tabcorp, and they've also now launched in the US. And that they thought of the market differently. And I guess those people, it's one thing to be focused on a niche that the others aren't going down, but evaluating the size of that niche. Like for us, we see some people that are doing stuff that's differentiated and different and hard to copy, but can it be $100 million revenue opportunity, or can it be $1 billion revenue opportunity? Because there's some stuff that's really differentiated, but it's only a very small market. So we see some products, some unique data in different sports and stuff like that is very interesting. And they've got highly skilled to be able to come up with it. But we go, well, what's the addressable audience? Like, how many people will actually want that? And so it's a combination of, we've got to get that right. We're sometimes wrong, but it's a combination of doing something that's different, but also that it's a big enough market to grow into and that it's worthwhile.
You've mentioned a couple of times the word data and proprietary data sets that different ventures have had. I'm curious though, with AI and the pace of change of AI, what's your kind of thesis around that, and how are you mitigating against it, but also leveraging the opportunity?
So in terms of mitigating against it, and then I'll get on to how we see it, is we option up many businesses. So we're not looking to try and dictate what the future looks like for customer experience in the gambling space. We're trying to see as many founders and businesses as possible and have lots and lots of bets as such through options. So we'll go to a conference next week and then 2 weeks after and then the next week, and we're like, oh, I had no idea that that's going well. That's amazing. That's so interesting. And so we're getting shaped all the time of where things are going in the industry. So we don't have a great feel of this is going to be the next product. It's more, actually, that's unbelievably interesting. We can negotiate good terms. We can buy that at what we think is value. Let's give it a whirl. But in terms of unique data, is that what we've found, we have spent a lot of time focusing on the professional betting segment of the market. So it's very hard to win betting. If you're betting on, I don't know, St Kilda versus Geelong, you may have a better understanding about that game than the bookies. You might know which players are out, which players play better when it's wet, when it's certain combinations playing, or whatever the factors that you look at. And you might be able to know that Geelong's value to win that game. And the bookies have got it wrong, because the bookies don't know the true odds. They just put up a percentage on each side, and supply and demand dictates where the odds are, and they know they've got some margin on their side, and they know that if you're betting all the time, the margin's against you, that it's going to be hard for them not to win. But on a particular bet, they don't know the true odds of what Geelong should be. So you may win if you're having 1 or 2 bets a year, or even maybe a round or something, but the average bettor bets regularly, and they have that margin against them, which makes it very hard for them to win. Except there are a few groups around the world that have thousands of people working for them and collect data and look at the game or look at the sport or look at the racing in a different way and cut up the data in a different way and then input it into their models, these thousands of factors, and can predict a truer probability than what the market can come up with or what the bookies can come up with. And they win large amounts of money. So you see groups like Tony Bloom, who owns Brighton Football Club, the largest soccer punter in the world, got an award from the King earlier in the year. David Walsh and Gelco, David Walsh owns MoMA Museum, the largest racing syndicate in the world. They're geniuses, these people, and they have found a way to win at betting on horse racing and on sport. But what we've seen when we look at that part of the industry is that there was value as years gone by of people getting public data and modeling it well. So putting it into their model, working out like off the public data what the true probability is, because people weren't good at modeling 30 years ago, 40 years ago, 20 years ago. The modeling side and using machine learning and AI, the modeling side seems to have got way easier, that everyone can model. Where we seem to think, and we're not experts in the space, we just look at the area. If I was an expert, I'd be running a professional betting syndicate. But in what we see is that the modeling has become more even playing field, but the collection of the way that you look at a game, sport or racing, the collection of the data of not public data and looking at it in a way that isn't accessible or easily accessible is where all the value is. So if you have, in a certain game, you have all the stats that are on TV and you're inputting that into the model, you're not going to have an edge. But if you can look at the game and cut the game up in a different way that most people aren't, and you're cutting out in a way that's value and then putting it into your model, it can be very valuable.
Super interesting. What about, I'm curious on the founder side, like do you make any assessment of the more humanistic side of the business, and how do you qualify and vet the operators that you're backing?
It's amazing that, so we don't like it unless someone's all in. So if they'd rather like die than let this business fail, that's amazing. We also see like the rhythm of communication. Like we have one set agreement. We can move very, very quickly as a team. We see some founders that are ultra slow, like getting back to email, replying, getting on calls, late to calls, or like they can't even get their own stuff together, let alone the company. But then you come across people that are just literally will go to the end of the earth to make this thing work. And we love that type of person because maybe their initial idea isn't as good as what they thought, but they are all in and will do anything possible to make it work in some way. And they're really exciting. And what's really exciting about them is we see that they've had successful businesses, successful exits. And we're like, actually, we'd love to use them to bring on board as a team of another company and invest. Oh, that person's a great person. So it's like a snowball effect of goodwill and positivity for that founder or that person, both money-wise and opportunity-wise. And then on the flip side, it's the other one. Like we've seen people that have had the most amazing ideas and they're just time wasters, you know, and yeah, that's and sometimes a lot of our options, they don't come off, and that's the model. We're looking for we only need a low strike rate of things coming off for it to go very well for the fund. And that's part and parcel that you meet lots of different people.
So obviously you have an amazing brand that you've developed in the industry. So from a deal flow point of view, that must be helpful. But so do you see every deal out there, or are you actively hunting and fossicking?
Probably it's a mixture of both. So we're the team, myself, we get a lot of inbound. We listen to, I hope, all the podcasts and everything in there, and the news and newsletters and stuff, analyst reports and everything on the industry. And we also go to, I'd say, nearly every conference that's on and basically try and have wall-to-wall meetings. Obviously, there's lots of business we probably don't see also. But really, like the value is, I know many of the players in the industry, I know the ecosystem, and I understand how gambling works to quite an extent. It's been my life and I've been in it for 20 plus years. But also to be side by side with the team. So I'll give you an example of like our head engineer who's just so switched on. We looked at a business and we had the ability to have warrants in the business, like 19% of the business warrants at a very reasonable price. Exciting, it looked exciting on paper, and they were listing and all this sort of stuff. And our head engineer said, look, the tech is just no good. Like, just don't do the deal. I wouldn't have known that. And so we didn't do the deal, thankfully. And then another business, similar business, but had done a token sale in 2018, had run out of money, needed money to keep developers on board. I was now based out of Vietnam. I was like, oh, I don't know about it. But I just picked on, he goes, look, I spoke to the CTO, I spoke to the team, looked at the code. For us to build that would take 2 years, probably $12 million of Aussie development costs. Like, they've done an amazing job. So we were able to option that up, what we thought was a reasonable price, and have an option for 3 years to buy 20% for $200,000 But because of his background and our investors know that how capable he is, we're able to fund that business for them, get $2 million in at a 4.9 million valuation very quickly, and we're able to sell the whole business for them at 23 million US within 5 months. And really, that was no skill of mine. Like, I got the inbound email, but it was our engineering team that can understand whether that tech is scalable, good. I wouldn't have even known what any of the code actually was. So it's you got to know the space, and you got to speak to all the people. You got to actually have the people in your team that can realize when things are value as well.
And Tom, how big is the investment team at Waterhouse VC?
So there's there's 9 of us, and yeah, it's not big, but it's I think highly skilled. It's highly skilled in this area.
And how many options are you taking per year?
Well, look, it just varies. So like in the last week, we've probably spoken to, I think we've spoken to 16 businesses in the last week. We're progressing calls with 5. I don't know if we'll go ahead with, maybe we'll go ahead in 1 or 2, maybe we won't, it just depends. But we don't need to do deals. And the reason why is what happens is, and so you get a bit more flavor on the fund, we're a fixed unit trust. So we distribute all of the gains and dividends every year to our investors. But our investors have liked what we do because they keep seeing deal flow from us. So they've put the money back into the fund. we don't really need that much money because we're optioning up these businesses. We're not like equity investors. We're not putting down big checks. And so we're sitting in a lot of cash, and we thought, well, what do we do? Do we put the money on term deposit? Do we put it into bonds? Do we put it into gold? And the family has followed a 13F strategy for the last 10 plus years. And we went to our largest investors and said, look, there's not many funds that beat the S&P over a long period of time, but these 16 funds have beaten the S&P for the last 30 years. Every fund with over 100 million in US equities has to release their 13F filing. We're going to follow these 16 funds, their 13F filing, and then we're going to apply these proprietary factors. And we got some of our large investors be comfortable with them, test them, and like, for instance, trading under 20 times PE, growing revenue greater than 20% year on year, very little debt, and a few others, and basically narrow down what those 16 best funds over the last 30 years, narrow down their positions to normally 5 to 10 positions. And then we evenly weight those positions, the cash into those positions, and then we back test against the S&P. So those positions, average PE ratios 13 times, S&P trades at 23 times. Our median growth rate of those companies is 27%, S&P is 18%. Sharp ratio is 1.07. We've outperformed the S&P since we started by 12% just in those. And we think we're in lower risk profile stocks. So we say to our investors, look, all your money is parked in what we think are high quality US equities. These are the list of the equities that they're in, and we rebalance once a quarter. So we're in no pressure to deploy money. The money just sits there for our investors. Our investors have to be comfortable that their money's sitting in what we think are high quality US stocks. But we think we're going to be hard to beat against an equity strategy because every 6 months or year or 2 years, we have hopefully a significant option deal come off, which it gives us great return. And so we're not under some pressure. Oh, we have to do 5 option deals this year. No, we just want to do high quality option deals. No pressure to do them. And as a family, we're happy for our money just to sit in large, like average market cap of that business. Those companies are 60 billion, large cap stocks, and just keep spending 99% of our time focusing on the option deals. And what's interesting for our investors is they like it because we have, unlike normal VC funds, we have monthly liquidity. So we basically say to our investors, if we're not constantly finding you option deals, well, you can just take your money out because we're just then an equity strategy. So and that seems to resonate with them.
Stepping back to a bit of the journey stuff, selling a business is not easy, and a lot of our listeners are either hoping to or have got it on the books. What did you learn from selling TomWaterhouse.com? What would you have done differently? What would you keep the same? All of that jazz.
Oh, so, and it's a great question, and it actually leads into why I love the fund, in that I realized with TomWaterhouse.com, it was worth, let's say in the 2-year journey of it happening at the beginning, let's say it's worth nothing. A year before we sold it, it's worth 10 times what we sold it for. And then a year later, it's worth a tenth of what we were offered in a sense. And the actual operational side of it only got better with that period of time. But what changed in that period of time is advertising landscape changed, competitive landscape changed, macroeconomic conditions changed. All of these things outside of our control changed in that period of time. And you see a similar thing with interest rates that went up in 2 years ago in 2022, in that these businesses that were suddenly high growth, great multiples, revenue multiples, suddenly that need cash, can't get $1 of cash. And as a founder, you put your heart and soul into a business, and sometimes it's amazing and you get this great result. And then other times you get an okay result, and other times you get nothing, but it's similar. You can be similar effort and execution, but there's so many things outside your control. And TomWaterhouse.com was such an amazing journey. I learned so much from it. It was a great result, what we end up getting. It just made me realize that you put your heart and soul into one business, and there's high execution risk. And I love that our model here is that you haven't got the same stake in a business, because obviously if you're a founder, you can hopefully be well over 50%, but we haven't got the same execution risk because we're backing many, many founders. And that's what I like about it compared to startup business. But startup business is, there's just such energy and excitement, and growth is an amazing thing to be around. So it's just an exciting time.
Any lessons learned on the investor side? Like you talked about before, having to educate them a little bit around how you're managing the fund and whatever else, but any key lessons you've learned on managing the investors?
Oh, well, so we're a boutique fund. So we're a wholesale fund. Majority of our people are in the industry or been around the industry, so they get what we're doing. And we don't think of ourselves in such as a fund manager. We think of basically these are people we like to be in business with, and we're going and finding great tech businesses. And but yeah, there's so much starting a betting business. I go, oh, well, I don't know that before. There's a blueprint. Just the whole running of a fund, compliance side, the custodian, insurance, AFSL, like there's just a lot of audit. All of the stuff that comes along with running a fund is new. It's really interesting, but it's new and different. And also making sure that communicating clearly, you have in your mind, you go, oh, that's our strategy. And you assume that everyone that's in the fund knows exactly the way you're thinking about it, but articulating that and making it clear and their understanding of where you're going long term is valuable. But it's much easier when you're going well. Everyone seems to be rah hockey sticks when you're going well. I think when you have a period of not going well, then that's a different story. I'll probably get a lot of learnings at that point, because one thing for sure is things don't go great all the time. That's for sure.
Yeah, absolutely. Can definitely relate to a few of those pieces. Maybe a bit more on a personal level. Who do you look up to? Like, who do you have mentors around you? Where do you draw your inspiration or advice from?
Well, definitely, like growing up, my grandfather and my dad, like they gave me a blueprint of success. I just lived and breathed like racing and betting, and my grandfather and I were in partnership for at least 5 years, and he'd go to the races. We'd go to the race all the time together at home, and he'd just yell at me on the way home and tell me I'm an idiot and I've got no idea and should have done this and shouldn't have done that. And he was probably right about everything, but it was great to have that relationship, because I'd known him always as a nice, friendly, cuddly, soft grandfather. And then he was just so tough, like really brutally tough, like are you an effing idiot? Like all the, just non-stop. Like it was amazing actually. And then my dad, well, I speak to my dad just all the time. He's just so intelligent and got such a great understanding of so many. He just is so widely read, and you can bring up the most random things. He just has such a good understanding and a different outlook on it, and is so giving. Really, he's. And also very, I know with my kids, I'm a bit worried, should I let them do this? He's always been like, oh, you think you can do that? You'll do that. Just, yeah, like unlimited belief, which gives you a lot of confidence. And then in terms of, I always quite admiring those people that have, or admire those people that have got higher goal of like things that are more broader than what they're doing in. So like a Muhammad Ali or an Elon Musk or these type of things. And every person you speak to, like, except maybe you guys, but definitely me and everyone I've sort of like read their autobiographies or biographies, everyone's a flawed character. You've got no people that you can put on a pedestal and go, oh, they're just amazing. Everything about them is incredible. But I definitely, as a person, I've got a narrow focus. I want to make this much money or get this return on investment in this business. But it's quite refreshing when you see people that are like, oh no, my broad objective is like to go to Mars, or my broad objective is not to be the heavyweight champion or whatever. I just believe in this. That belief thing is quite inspirational.
Are there any rules and principles that have been passed down from your family in the betting space that you've applied directly in the investment space?
Yeah, definitely. Limit your losses and unlimit your wins, which we've definitely tried to do with Waterhouse VC. So we're very, like, we don't have any equity position over 5% of the fund. We I think, like, as long as you're happy being exposed to US equities, that's the risk. We option up at what we think is value. We have, they can go to any value. So we adopt that strategy. And I think also in businesses that, I love businesses that let revenue obviously lead costs, but if you've got a lean business and a savvy group of people, you can pivot, and you need to pivot so many times because things are always changing. And I definitely went through that with bookmaking and tomwaterhouse.com, and yeah, it's definitely been a good lesson.
What are you most excited for in the ecosystem in the next 12 months? And also, Michael shared that you've done a JV, is it, with RAS Technology Holdings? That looks exciting as well.
Oh, I think so. Yeah, I think they're a very, very exciting company. Love the team. Spent quite a bit of time with the team, Stephen and Gary Crisp and Tim Oliver, their CFO. They've got, we think, a very special data set on racing. They've got the deal with stake.com for racing. They're building managed trading service functionality to help manage the trading of these businesses. They're building a platform and mobile apps. They're exciting. We bought a 2.5% stake in their business at a 15% discount to the VWAP of 12th of August. And then we've got another 2.5% option that we can buy over the next 3 years at $1.40. And then based on certain revenue, we have ability over the next 3 years to get another option of 10% of the business. And we think that business is very, very interesting. And yeah, we're excited to be investors with them and think that they're long-term player in the industry. And we think racing, we're very bullish on it. I was speaking from my origins, but I'm very bullish on racing as a product globally. It's a perfect betting product. And once people take to it, bookmakers love it because it's much higher margin than football or basketball. It's built for betting. And I think racing and sports has a big role to play.
Are you looking for new investors, or you guys have got so much capital you don't actually need any more, and therefore asking how people get in touch with you is a bit pointless?
So the fund is only for wholesale investors. We're at 75 million AUD at the moment. We plan to close the fund just to existing investors at 200 million, and the reason being is because we just don't think if we have unlimited money in the fund that we can get spectacular returns. And maybe we don't get spectacular returns with less than 200 million in the fund, but we're a chance to, because we're getting deal sizes that actually move the dial at that sort of value. And so, yeah, we spend 99% of our time searching for option deals, because we basically go, if we keep finding great deals and we keep going, well, the funds look after themselves. But yeah, we're never going to be some large mega fund.
But if they're in that structure, if there are people that are interested to at least find out, how do they?
If they're a wholesale investor, they should go and have a look at Waterhouse VC, waterhousevc.com.
So with the option deal, so in our world, we're deploying equity. Some work out, some don't, and we always try and look at why were we so bullish to begin with, and then what went wrong. So in your world with the option deals, when it doesn't come off, are there some common patterns as to why? Is it execution? Is it just market? Is it?
Yeah, there is. So, and this is one of the reasons why we like a business like racing and sports and business like a platform, is that businesses that hope by selling us an option and having us on the register as having an option that can help them with distribution. We know most of the players in the industry, but to get into the product roadmap of a FanDuel or a Tabcorp, if they're relying on getting into that product roadmap through our option, it's still hard. It's really hard because they've got so many competing priorities in these large organizations, and their tech roadmap is so long. So getting companies that we do options and finding them a way to launch with 50 to 100 bookmakers that are not maybe tier 1, but a tier sort of 2 or 3, well, you can actually see whether the voice betting solution or the esports data solution or the basketballs like data solution, whether it actually is good across a whole bunch of smaller bookmakers. And if it's going well for them, the large operators will just do it anyway. So that's probably a really good learning that we've had over the last 5 years, is that we need to solve a way that when we do option deals, it's a much clearer roadmap of how those businesses get integrated and get distribution quickly.
We're finding in the areas that we hang around, horizontal solutions are now becoming vertical. So whereas before someone might have 5 different products to run their business, now people are saying, actually, I'll solve end to end for your business in this space that you're playing, are you seeing similar, or you still at that horizontal level of providing different parts and they've got lots of other different parts that they're buying elsewhere?
No, it's a good point. It's a good point. Like you're saying, like all racing sports are a good example. They were just supplying racing like insights and data, and now they're supplying racing insights and data and the betting platform and the mobile app and the trading. So you might have to before either employ all different people to do that, but now they can just do it out of the box for you. So you're spot on. I think that's definitely across both the areas we look at very similar.
Well, one other thing that comes to mind, the space you're playing in, like highly regulated, and you talk about limit the downside, but how do you navigate that? And is that why you're fixated also on the not the operational side, but actually the picks and shovel side?
Correct. I think we're just in a 10, 20-year period of, I think you're seeing more opening up of jurisdictions. There's more places regulating and opening up, but they're regulating in with strict restrictions and taxation, which makes it hard for the operator to make supersized profits. And I think that in that environment as an investor, if you're looking to outperform the market, the companies that are outperforming the market are the suppliers at the moment. Maybe that changes in 10 years' time or something like that, but we don't have a good enough grasp of where, like if you said, well, look, it's just going to end everywhere where it's 30% of gross profit tax for operators, that would be much easier to understand. And you can definitely for the next 10 years do this in advertising, but it just changes all the time and it changes around the world all the time. But having much smaller option size investments in bets on companies that are suppliers, we think it's a much lower risk strategy.
I'm mindful of time, and we've got a few minutes left. But people that are known to other people, sometimes people misunderstand things about them. Are there things that people misunderstand about Tom Waterhouse?
I don't know. It's funny, isn't it? Like, I just don't think about it. I don't know. It's hard because for a period of time I was on TV all the time with all of that advertising around tomwaterhouse.com. And I just know how I was so terrified going on the TV because first I didn't know that much about rugby league. I wasn't closely following the game. And secondly, I'm not some TV expert. I actually head of Channel 9 Sport when I went in for the dry run. He goes, I've never seen anyone with less talent in my whole time on television ever. So
Is that your grandfather or?
No, that was the guy called Steve Crawley. I did the green screen. He's like, in my whole time working in TV, I've never seen anyone with less talent. And so that was very intimidating and scary to be on live TV to like 1 million or 2 million people. And I remember I was on Dancing with the Stars, it'd be 20 years ago now. And I was just, I would have gone to the toilet 20 times or 30 times before going on, just because it's so scary. Like, so I'm not naturally a public speaker or a TV person, at least it doesn't feel comfortable to me. But in terms of the people you hang out with and your family and your kids and your wife and your parents and stuff, it's so narrow and you know them so well and you're in that little bubble, and the rest of the world, if you've got some sort of public profile, but you just not exposed to it. Maybe in that height of when you're doing the rugby league advertising, there's some, but it just doesn't really come into play because you're in that bubble of your own little friend and family world.
That's really interesting, and appreciate you sharing that more personal aspect. Look, this has been a great conversation. I've learned a number of things, and it's the fact that it's a multi-pronged strategy that has risk management at its heart. That's really cool.
Yeah, it's been a fantastic conversation. So good to hear more about your model and how you approach things.
Thanks, guys. I appreciate having me on.
So we'll put a link to all the stuff we've discussed in there. Tom's on LinkedIn as well and puts updates and those kinds of things out.
Love the combo. Thanks so much, Tom.
Thanks. Appreciate it.
Thanks, Tom. Appreciate it.
Have a good day. See you guys.
Thank you
Bye.
so much. Appreciate it.
Bye.
Oh man, he's sharp. I really enjoyed that combo.
That was really good.
So
Really
sharp.
bloody good.
There's a lot of thought.
I love their strategy. Like that
Yeah.
is oh man, that's like Taleb.
Yeah.
Like that's a barbell strategy. Like you're just optioning to get the asymmetric return, but then 95% is in really safe equities.
Yep.
So about 20 years ago when I was screwing around with automated trading and stuff, I dreamed up a product called capsule is what I called it. I remember there was a black logo that I came up with, and the idea was in a high interest rate environment, I think at the time you could get an easy 7.5% on your money.
Yeah.
So the idea was investors put, say, for every $100 in, you go put your $92.50 or whatever in the term deposit, and then you go and invest in futures, foreign exchange, and options. That's $7.50. And the idea being that if that strategy turns to shit, you lost a $7.50, but it matures at 100 cents in the dollar. If it goes all right, your interest gets you back to $100, and then your profits on top.
What I don't understand on the options, and I was like, didn't want to ask, it sounds stupid, but why would the investor accept the option? Like, would they have to do an
Distribution.
So
Distribution.
that's the value add there.
So I'm Tom
I mean, why would the
Waterhouse.
founder accept it?
Yeah.
I'm Tom Waterhouse.
Yeah.
I'm going to plug you into this network. I'm going to get you this volume. I'm going to do these bits and pieces. There'll be an option fee as well. I'll give you $500,000 for an option to acquire X percentage at whatever else. And if it pays off, my option, let's say I paid $500,000. If it pays off, I'm getting $50 million back, and you've got a company worth X dollars. And if it doesn't pay off, well, you got my money.
And it's non-dilutive in that case. Like, it's fucking, it's a good strategy.
See you guys.
All right, boys. See
See
ya.
ya.
Bye.